everyone, and welcome to your first lesson, the evolution of Forex. Before you can begin to understand Forex, I have to take you through the past to understand the history of the foreign exchange market so you can understand where money comes from and where we got to where we are today. In this lesson, we'll be going over the evolution of money, transitioning from the bartering system, commodity system, coin system, paper money, the Bretton Woods system, and ultimately what we have now, the foreign exchange markets. Understanding the history of our money, monetary system, the evolution of where it was to where it is now will definitely put you in a better position to capitalize on the movement of money. First up, we have the bartering system. The bartering system was a system of exchange between goods and services. They didn't have cash back in those days, so goods were literally exchanged by a transfer of materialistic things or items. Back in the day, people literally traded everything. They traded livestock. So when you think about slavery, it was the trade of people, and some people even traded skills. So let's say in today's terms, someone's good at personal training and their client's trying to lose weight, but the client is good at websites. So the client says, hey, I'll build your website if you train me for free. That's an example of modern day bartering system. Now, in that time, you would see bartering systems in societies that did not have good economic advantage, but the bartering system failed because it isn't good for a lot of reasons. Let's say I have something that isn't as valued as something as you have. So back to the personal training example. Let's say a trainer charges $300 a month, but the website being built is $1,000 value. The trainer will have to offer 3 months of free services to equate to what the website developer is giving. That's an example of modern day bartering system, but it was the same back in the day. So next up, we have the commodity system. Now let's talk a little bit in depth about the commodity system because throughout history, there have been 4 main categories of commodities. So we have energy commodities like crude oil, natural gas, and gasoline, metal commodities like gold, silver, and platinum, livestock commodities like pork and cattle, and agricultural commodities like corn, wheat, rice, cocoa, and sugar. In slavery days, they used cotton. However, all of these commodities were traded as units of measurements. But the problem was these units of measurements go by weight. Therefore, the transportation of these things posed a problem. In today's society, we use gold, but you'll never hear someone say, hey, let me go get this bar of gold out the safe so I can pay for this and I'll be back. So clearly the commodity system didn't work and we transitioned to what we have is the coin system. Now, the coin system introduced a new idea of universal economic value dating back to 700 BC. This type of currency exchange had a large impact on all the world because it offered an easier way for exchange of goods and services. The coinage was made out of electrum, which paved the way for allowing people to trade what they needed and gave way for people to participate in the foreign trades. However, coins were extremely heavy, transitioning to the invention of paper money by way of the Chinese. The Chinese came along with the invention of paper money as notes from private institutions. These private institutions became known as what we have today, which is called banks, and paper money was given in exchange for holding gold and silver. There were huge disadvantages to paper money, such as paper money could easily be counterfeited, kind of how currency is today. And the other issue was banks frequently printed out way more money than they actually had stored in their vaults, basically equivalent to what Donald Trump did with our economy and inflation. Banks and institutions were printing so much money that it lost its value. The overabundance of printed money and money being printed gave rise to all countries coming together to create the gold standard. The only problem was that gold needed to be free flowing and each country had to be able to maintain the money supply to a fixed quantity of gold. So if there was going to be any type of exchanging of paper money, then they also had to exchange gold. In other words, if you wanted to send someone $50,000 in Europe, then you also had to send them $50,000 worth of gold, which made it extremely hard to create this means in all countries. As time progressed, the value of revenue deflated and countries diverted back into their old ways. This introduced the Bretton Woods system. Countries decided to come together once again to try to find a monetary trading system that would not allow countries to print money at their leisure and also have a sustainable system that would allow them to keep currency exchange rates fixed and allow them to trade things a lot easier without having to have a huge transfer of money or gold to follow. At the end of World War II, European countries were devastated, so 44 countries came together and created the Bretton Woods system, making it advantageous to anyone who decided to participate in foreign trade. At that time, the United States held 2/3 of all the world's gold, so the United States dollar was chosen to be the world reserve currency, as it is the biggest and most widely used exchange and liquid piece of currency in the world. Out of the Bretton Woods meeting came two different types of institutions, the IMF and the World Bank. The IMF's job was to regulate how much money was being printed and lending money to new countries to prevent it from devaluing. The central bank's job was to help emerging economies build up their infrastructure and help them participate in foreign trade by lending them money. While this was beneficial, President Nixon ended the Bretton Woods system, announcing the US dollar would no longer be backed by the gold standard in 1971. The system inhibited the United States economy because there was a scarcity of gold, because many countries were constantly asking for gold in exchange for their currencies. This transitioned to what we have today, known as the foreign exchange market. This is a floating exchange rate system which is dictated by supply and demand opposed to government regulations. When prices of currency are dictated by supply and demand, prices are subject to change and change freely, regardless of their governmental bodies. The main countries with these currencies are systems like the United States, Britain, Canada, Europe, Australia, Switzerland, and Japan. So I hope you guys understood the evolution of money and where we are today and where we came from. Now that our history lesson is over, we can get down to the fun nitty-gritty of everything, but definitely keep in mind what you've just learned, because we will definitely be revisiting our commodities.